Introduction to Accounting. We'll start this course by introducing and explaining the most important terms that you will see over and over again in this course. You will need to grasp what each term means to understand the concepts in this course. Assets. Assets refer to resources that an individual, organization, or entity owns, controls, or has access to and which can provide future economic benefits. Assets can take various forms, including cash, investments, real estate, equipment, intellectual property, and inventory. In accounting, assets are typically classified as current assets or non-current assets. Current assets, such as accounts receivable and inventory, can be easily converted into cash within 1 year or less. On the other hand, non-current assets have a longer lifespan and cannot be easily converted into cash, such as property, plant, equipment, and intangible assets. Overall, assets are an essential component of an entity's financial position, as they can be used to generate revenue, reduce liabilities, and increase the value of an entity. Liabilities. Liability refers to an obligation or debt that an individual or entity owes to another party due to a past transaction or event. In other words, it is a financial obligation or responsibility that an entity must pay or fulfill in the future, usually in cash or other economic resources. Liabilities can take many forms, including loans, accounts payable, taxes owed, wages payable, and deferred revenue. Liabilities are typically classified as either current or non-current liabilities. Current liabilities are liabilities due within 1 year or less, while non-current liabilities are obligations due more than 1 year in the future. Liabilities are essential to an entity's financial position, as they represent potential claims on an entity's resources by its creditors or other third parties. They are also a key consideration for investors and creditors when assessing an entity's creditworthiness and financial health. Equity. Equity refers to the residual interest in an entity's assets after deducting its liabilities. In other words, equity represents the ownership interest of the owners or shareholders in an entity's assets. Equity can take different forms depending on the type of entity. Equity is typically represented by common stock, preferred stock, and retained earnings in a corporation. Common stock represents the ownership interest of the shareholders in the corporation. In contrast, preferred stock represents a particular class of ownership that usually prioritizes common stock regarding dividend payments and liquidation preferences. Retained earnings represent the portion of a corporation's earnings that have been retained and reinvested in the business rather than distributed to shareholders as dividends. Equity is an essential component of the balance sheet in accounting, as it represents the entity's net assets available to the owners or shareholders. It is also essential to an entity's financial health and long-term sustainability. Investors and analysts often use various equity ratios, such as return on equity and earnings per share, to evaluate an entity's profitability and growth potential. Debit. In accounting, debit refers to an entry that increases an asset account or decreases a liability or equity account. Debits are recorded on the left-hand side of a T account, which is a visual representation of an account that shows the debits on the left side and the credits on the right side. For example, when a business purchases equipment for cash, the asset account for equipment increases, and the cash account decreases. This transaction is recorded as a debit to the equipment account and a credit to the cash account. Debits are also used to record expenses and losses, which decrease equity or increase liabilities. For example, when a business pays rent expenses for the month, the rent expense account is debited, and the cash account is credited. It is important to note that in double entry accounting, every transaction must have at least one debit and one credit. The total debits must always equal the total credits per the fundamental accounting equation. Debits and credits are used to keep track of the flow of financial transactions within a company and ensure that the financial statements accurately reflect the company's financial position and performance. Credit. In accounting, credit refers to an entry that increases a liability or equity account or decreases an asset account. Credits are recorded on the right-hand side of a T account, a visual representation of an account showing the debits on the left and right sides. For example, when a business borrows money from a bank, the liability account for the loan increases, and the cash account increases. This transaction is recorded as a credit to the loan account and a debit to the cash account. Accounts receivable. Accounts receivable refer to the amounts of money owed to a company by its customers for goods or services that have been sold but have yet to be paid for. Accounts receivable represent a company's legal claims against its customers for payment and are considered assets on its balance sheet. When a company sells goods or services to a customer on credit, it issues an invoice with payment terms, such as net 30 days, which means the customer has 30 days to pay the invoice amount. The amount the customer owes is recorded in the company's accounting system as accounts receivable. When the customer pays the invoice, the amount is recorded as a decrease in accounts receivable and an increase in cash or another payment method. Accounts receivable management is essential for a company's cash flow and liquidity. Companies must monitor their accounts receivable to ensure that customers pay their invoices on time and follow up on any late payments or overdue accounts. They may also use financial tools like factoring or accounts receivable financing to convert accounts receivable into cash. Revenue. Revenue refers to a company or organization's income from selling goods or services to customers. It is the amount of money a business generates from its primary activities, excluding any deductions for expenses, taxes, or other costs. Revenue can come from various sources, such as the sale of products, fees for services provided, or interest earned on investments. Revenue is an essential measure of a company's financial performance and is often used to evaluate its growth and profitability. Accounting records revenue when earned, regardless of when payment is received. This means revenue is recognized when a sale is made, even if payment is received later or in installments. Credits are also used to record revenues and gains, which increase equity or decrease liabilities. For example, when a business sells goods or services on credit, the accounts receivable and revenue accounts increase. This transaction is recorded as a credit to the accounts receivable account and a debit to the revenue account. The accounting equation. The accounting equation, also known as the balance sheet equation, is a fundamental concept in accounting that represents the relationship between a company's assets, liabilities, and equity. It can be expressed as assets equals liabilities plus equity. This equation reflects the fundamental principle that a company's assets are financed by its liabilities and equity. In other words, the resources or economic benefits that a company owns or controls, assets, must be either funded by outside parties, liabilities, or by the owners of the company, equity. Here is a brief explanation of each component of the accounting equation. Assets are resources or economic benefits that a company owns or controls and can provide future economic benefits. Assets can take various forms, such as cash, investments, inventory, property, and equipment. Liabilities represent a company's financial obligations or debts that must be paid or fulfilled in the future. Liabilities can take different forms, such as loans, accounts payable, and taxes owed. Equity represents the residual interest in a company's assets after deducting its liabilities. Equity can be broken down into standard, preferred, and retained earnings. The accounting equation is the foundation of the double-entry accounting system, which businesses use to record their financial transactions. Every financial transaction a business engages in affects at least two accounts, with one account debited, which means increased, and another credited, which means decreased. The debits and credits must always balance to ensure the accounting equation remains balanced.